The U.S. Bureau of Labor Statistics was forced to publicly refute a false inflation data report that surfaced on Tuesday, just one day before the official publication today. The paper, which attempted to mimic the structure of the monthly consumer index, asserted that annual inflation rose to 10.2% in June, higher than the economists' expectations of 8.8%. And speaking of inflation, markets are bracing for that report, which will be due later today. For more on these headlines, we're going to go joined by Efosa Aluyi, who is the head of investments at Sankore Global Investments. So, Efosa, thanks for joining us. We have fake U.S. inflation reports flying around. The forecast is for 8.8%. How much pressure does high inflation in the U.S. put on the economy and stocks?
Well, I think the pressure from that inflation number really is around what it does to action going forward. Recall that the Federal Reserve, in a bid to cool inflation, has been on a hiking binge over the last couple of months. We saw a 75 basis points hike last month. We are all set for most likely another 75 basis points hike towards the end of the month when the FOMC reconvenes for that meeting again. So I think that's the major piece of data that the entire market is looking to. That data should be out later on today. The estimate or expectation is that we should have an 8.8% print, higher than the 8.6 that we had last month. Once we get this sort of printing, it just continues to put pressure on the Federal Reserve to maintain costs on a 75 basis points hike. And that would also not go well for risk assets generally and for stock markets. And we should also see a repricing even in fixed income, particularly in the US. This has been the path that the Federal Reserve has been on. The idea, again, is to try and cool inflation and, reduce, the pace at which the economy is moving to ensure that they are able to engineer a soft landing. So I think that's the idea. And I think that's the reason you're probably seeing speculations around that inflation number, because it is very, very crucial for what the Fed does next.
What do you make of Google being the latest tech company to slow down hiring? I mean, is the recession in the U.S. going to become a self-fulfilling prophecy?
It is likely to happen. I mean, this is not surprising. Like we said, I think the last time we spoke, about 30,000 jobs have been shelved off by tech companies in the US this year alone. And that trend is likely to continue. I mean, for Google, they've hired quite strongly and quite significantly over the last couple of months. What they want to do now is to try and focus on the investments that they've made. Do not be surprised if you see other companies, particularly within the tech space, coming out to also announce hiring freeze or likely cuts in their workforce. Like I said, the increase in interest rates that we are seeing being implemented by the Fed is going to hit, the tech sector even more broadly and more aggressively, because as money becomes more expensive, as interest rates rise, the value of these growth companies, is then tampered. So that's the trend that we're likely to see even going forward. So more companies are likely to even come out to announce hiring freeze or a slash in their workforce.
Let's talk oil. I guess we can combine this together. OPEC and the IEA, International Energy Agency, both sounding cautious, if not bearish. What do you make of their reports?
Well, I think, the issue really is around the fact that we're heading into a global slowdown. Make no mistake about that. I think the question is whether the U.S. economy, for instance, is going to tip into a recession or not. We're seeing, a COVID-induced slowdown, particularly in China. We're seeing an energy-induced slowdown in Europe. So clearly, we're heading into a global slowdown. And this obviously has implications for the demand side of energy consumption. Now, if you look at the supply side, years of underinvestment, the whole energy transition mantra that had been on for the last couple of years, basically created a perfect cocktail for, reduced supply. And of course, by the time you throw on the whole Russia-Ukraine situation, it then even further exacerbates that. So I think that, OPEC and the OECD, I don't think it's too bearish. They're essentially just, stepping up to reality and saying it as it is. I expect that, global demand in terms of crude oil will start to taper off going into next year as, global growth slows.
And, real quick, what do you make of the trade numbers we've seen coming out of China for the first half of the year?
Well, I think it's just a reflection of, a lot of stuff that has gone on. The trade surplus basically soared to about 97.9 billion in June. just basically coming off the fact that lockdowns had essentially been eased, particularly in Shanghai and in Beijing. But it's also important to point out here that we've seen a bit of a resurgence in those COVID cases for the last week or so, and lockdowns might, be coming back. But just a bit of context to those numbers again. Exports rose by about 17.9% to 331 billion. I think one significant thing to also take away from this number is that imports only rose really slightly, and that's a reflection of the weak construction activity in China. We've seen the issues that have bedeviled the real estate sector in China. We saw the whole Evergrande issue recently, Shimao. So all of that just reflects, the slowing of the construction industry, and that number is clearly set in what we have seen in those import numbers. I think that output growth in terms of GDP for China this year is certainly going to be slower than the 5.5% that is expected. Q1 GDP came in at 4.4%, lower than the 4.8% that have been, expected. And that hasn't factored in the COVID lockdowns that we've seen in China. And you throw on top of that the fact that those lockdowns are likely to come back again as cases sort of like resurface and resurge. It only just means that Chinese growth for this year is going to be significantly lower than expectation. And this would have implications for global growth.
Efosa Aluyi, head of investments at Sankore Global Investments, thank you so much for taking us through the headlines. We appreciate your insights.